You'll often hear media pundits warn that this time is different. The underlying message here is that despite a wealth of evidence showing otherwise, what's happening today is really something uniquely different that will impact markets for generations to come. One noted skeptic of such logic is Michael Humbert. He is an investment strategist and noted student of financial markets history at Dimensional Fund Advisors. Hi, Michael. Thanks for joining us here today.
Thank you for having me.
It seems like every few years we see a wave of market prognostications casting fear and doubt about something going on in the news. While it might be true that the world poses many dangers, how many of these predictions turn out to be truly meaningful for stock investors?
Murray, that's a good question. And I think the answer to that depends on what kind of investor are we talking about? Are we talking about the investors who listen to these predictions, who listen to these prognostications, and try to use them to beat the market? Then these predictions are significant to their experience. And my word choice there is deliberate. I chose significant, but I didn't say necessarily helpful. In contrast, if you're the kind of investor who focuses on their goals, you're able to tune out most of that noise and maintain a disciplined allocation that helps you achieve those goals in the long run.
Yeah, I guess it kind of feeds on itself too. Fear mongering about recent events just kind of pushes people to follow their worst fears and anxieties.
Staying in your seat is probably the best thing an investor can do, and also the most difficult thing to achieve because, to your point, we are bombarded by information. It's only natural to want to try and react to that, to try and do something. But importantly, if that information is coming across your news feed or your TV screen or your newspaper, whatever your medium for ingesting the information, if it's there, it's also already in market prices. There's very little an investor can do with that information that isn't already reflected in our expectation for the future via the price mechanism, via buyers and sellers, incorporating that into prices. It's much better investment experience to try and not focus on that and rather focus on your goals and how you achieve them.
At IFA, our wealth advisors like to talk a lot about how our allocation investment process is very passive, and that the funds we prefer to use, which are from Dimensional Fund Advisors, kind of blend the best of both indexing and a little more enhanced strategies. Can you explain in a nutshell what that means?
Oh, absolutely. Thank you. Indexing passive investment vehicles, they're one of the greatest inventions that we've seen in my professional lifetime, right? They're low cost, they're broadly diversified, and they do exactly what they say they're going to do. They look like the index. It has enabled investors to get broad market exposure and to help them grow their wealth over time by participating in the positive expected returns that equities have. What dimensional does is we think that that's a great starting point, but you don't have to stop there. You can maintain a lot of the benefits and characteristics of a passive approach, such as that broad diversification and that low cost. But you can layer on the pursuit of higher expected returns. You can take what we know about the sources of higher expected returns, smaller market capitalization securities, lower relative price securities, those value stocks, and those stocks that have higher profitability. If you just tilt a little bit towards those and away from the lower expected return segments of the market while maintaining broad diversification and do so in a cost-conscious way, you can have a better investment experience than what a passive approach alone can offer.
And in value, profitability, size, those are called factors, correct?
Absolutely. We tilt towards those factors. We see them looking back to intuitively, we expect them due to valuation theory, and economically, we see them in the data going back in the US almost 100 years.
Hmm. Yeah, and I should emphasize too that IFA, as we defined index funds, we still consider DFA funds to be largely passive. And I know we've talked to Morningstar, FactSet Research, FTSE Russell. There's kind of a blurring of the lines, so to speak, between, with the popularity of passive index funds and by active managers who are trying to, frankly, get in on the game. And so they're trying to play both sides of the fences. I think you folks are pretty much described as index-like. Could you kind of explain how DFA sticks to more of a passive approach in terms of putting together a fund and then managing it, how it kind of enhances the process?
Absolutely. Certainly have more in common with a passive index fund than with those traditional active managers who may hold a portfolio of a few dozen stocks and they have 200% turnover because they're making tactical bets within that highly concentrated portfolio. Relying on their investment expertise to beat the market. What we do is we really start with the market, very similar to that passive approach there. And then as markets are updating every single day, prices are incorporating new information every single day, it's informing us as a manager which securities have higher expected return. As a stock migrates from value to growth, that changes its expected return characteristics. And as such, we want to change how our portfolios are positioned just a little bit every single day, but we do that cumulatively. It compounds to the benefit of the investor. So similar to a passive approach in that broadly diversified, low cost, looking like the market, but then just tilting away from the market a little bit so that we pursue those higher expected returns.
Sure. And again, IFA has stated that Dimensional's academic rigor and systematic investment process does provide our clients with consistent, efficient access to key markets and asset classes. And our research shows that DFA's highly structured trading methodology is executed in a fashion that reduces both implicit as well as explicit management and operational costs to fund investors. So it kind of is an enhanced indexing type of strategy that it still stays true to the major characteristics of traditional indexing.
I think that trading point that you brought up there about the implicit and explicit costs is important to drive home because how you pursue these securities matters. It's not just enough to go size, value, and profitability to tilt towards factors and then call it a day. You really want to approach that with a patient and flexible approach. I want to make sure that when I'm engaging with the market, I'm not crossing bid-ask spreads. I am making sure that I trade in a way where I'm minimizing my impact on the market, blending in with that natural liquidity that I see every single day, and making sure that I am where I want to be with the portfolio, but how I get there matters as well. How I trade these names matters as well. At Dimensional, you'll hear people say we fight for every single basis point because we think it matters over the long term. Those basis points, they compound, and the power of compounding is not something that we are willing to leave on the table if we can obtain it in a cost-effective way.
Okay. Thanks, Michael.
Thank you, Murray.